Your bank loves it when you open a high-yield savings account, not because you're about to get rich, because they just found another customer who will park money in their vault for 20 years while they lend it out at 24% APR. Marcus knows this. Jack does not. Jack just got a raise. First thing he did? Opened a HYSA at 4% APY. He checks the app every morning, watches $17.43 hit his account. Feels like Warren Buffett. But here's what Jack doesn't see. The bank takes Jack's $50,000, lends it to someone else as a credit card at 24%. They collect the spread. Jack gets his 4%. The bank keeps the other 20%. And Jack smiles at his monthly statement like he just won. You are not the customer at a bank. You are the product. Your deposit is their inventory. Your 4% is just the wholesale price they pay to stock the shelves. Now let's talk about the part that makes this worse. Taxes. That 4% interest you earned? The IRS treats it as ordinary income, same tax rate as your salary. If you're in the 22% federal bracket, you lose almost a quarter of your gains before you even touch the money. Add state taxes and your 4% becomes closer to 3%. And that's before we talk about what inflation is doing to the rest. Inflation right now is sitting around 3.5%. Do the math. Your 4% HYSA is taxed down to 3%. Then inflation eats another 3.5%. Your real return is negative 0.5%. You are losing purchasing power. Every single month, the money is growing on the screen, but the things that money can actually sort are shrinking. Your balance says 52,000. Your purchasing power says 48,000. The number goes up. Your wealth goes down. And the bank sends you a cheerful email about your great rate. Jack thinks he's saving. Marcus knows he's decaying. Marcus does not use a HYSA to build wealth. Marcus uses it for exactly one thing: the emergency buffer. 3 to 6 months of expenses. That's it. Money you might need within 48 hours. Money that cannot afford to drop 30% in a market crash the week before your car dies. That money belongs in a HYSA. No debate, no alternative. It is the perfect tool for that one job. But everything above that number? Every dollar beyond 6 months of expenses that Jack is letting sit in a savings account? That is where the real mistake lives. Here is the math that should make you uncomfortable. $20,000 in a HYSA at 4% for 30 years. After taxes and inflation, you end up with roughly $65,000 in real purchasing power. Same $20,000 in a low-cost S&P 500 index fund at the historical 10% average. After 30 years, $348,000. Same money, same 30 years, same person. A difference of nearly $284,000. That is not a rounding error. That is a house. That is a kid's college education. That is 3 extra years of retirement. That is the cost of feeling safe. The bank sold you comfort. Marcus bought assets. Now let's make this concrete. Marcus follows 3 rules with his savings. Rule number 1, know your number. Calculate exactly 3 to 6 months of expenses. Rent, food, utilities, insurance. The bare minimum to survive. That number goes into a HYSA, not a dollar more. The account has one job: protect your life from emergencies. It is not your wealth builder. It is not your retirement plan. It is your shield. Nothing else. Rule number 2, automate the overflow. Every dollar above your emergency number gets automatically swept into a brokerage account every month, same day, same amount. You do not see it. You do not think about it. You do not get attached to a big balance that makes you feel rich while making you poor. The money leaves the savings account before your brain has time to negotiate. Rule number 3, stop treating your savings account balance like a scoreboard. Jack opens his banking app every morning, sees $53,000, feels accomplished. That feeling is expensive. It costs him $28,000 every 10 years to feel that feeling. Marcus opens his brokerage account, sees his index funds, sees 10 years of compound growth. He never opens his HYSA app because that account is not the main event. It is the popcorn before the movie. The rate is also not permanent. Understand this. The Federal Reserve can change rates tomorrow. Your HYSA yield is not backed by a business generating real revenue. It is not an asset that appreciates. It is a number on a web page that your bank can change without calling you. Between 2015 and 2022, savings accounts paid essentially zero, for 7 years. If you had built your entire strategy around 4% yields, what happens when rates drop to 1% next year? You scramble, you move money between banks. You chase promotional rates that expire after 3 months. Or worse, you do nothing, and your money sits earning 1% while the market compounds at 10. Jack will scramble. Marcus already planned for it. His emergency fund sits in a HYSA because it is convenient and liquid, not because of the rate. If the rate drops to zero tomorrow, the fund does not move, because its job was never to earn interest. Its job was to be there when the transmission falls out of his car at 90,000 miles. That is it. So here is where we land. A high-yield savings account is not a scam. It is a tool that most people are using completely wrong. It is a storage unit for emergency cash. It is not a wealth-building strategy. It is not an investment. It is not going to make you rich. And if you are treating it like it will, you are not saving. You are slowly losing. The bank wants you to confuse safety with progress, because a confused customer is a profitable customer. If you want to know exactly which low-cost index fund Marcus uses and how he structures his automatic transfers every month, comment the word Episode 8. That video drops next. This is Jack and Marcus Finance. We tell you what Wall Street does not want you to know.